Well, earlier today, Moody's Investors Service released a report urging the U.S., the U.K., France, and Germany to control spending on pensions and health care in order to stabilize debt levels. Well, that's not news to our next guest, who's pocketed big profits by avoiding government debt issued by the U.S. and really most major European countries. Michael Hasenstab manages the $46.2 billion Templeton Global Bond Fund, and Bloomberg and Morningstar both chose him as the #1 global bond fund manager for 2010. So, Michael, you're the perfect person to talk to about this. So is Moody's right? I mean, do we have to be very careful when we look at the U.S., the U.K., France, and Germany at this point?
I think it's important. It's not a solvency issue where there are a lot of governments that are facing serious solvency problems within Europe. But there is no question that U.S. fiscal policy in the long term is completely unsustainable. We need to tackle some of the long-term entitlement issues that are being completely ignored. There's a very limited scope with changing discretionary spending. We really need to deal with healthcare costs and retirement costs, and until those are done, our debt path is on a very precarious path.
So they've got a AAA rating. Do they deserve it in your view? Because we've talked to some folks, Steve Kroll, a frequent guest on our program, who says the U.S. is going to lose its AAA rating this year. Does the U.S. deserve a AAA?
Yeah, it's probably likely to keep it. I mean, I think policy can be corrected. And as again I mentioned, it's not so much a solvency issue and it's not a liquidity issue. It's really a longer term debt sustainability question. And so I think the immediacy is probably not there, which is part of the problem. Without an immediate crisis, policymakers don't act. And so I think it's good, though, that some of the rating agencies are sending a warning shot to maybe shock policymakers into some action.
I don't want to dig too much into this. But, you know, I had a viewer write in earlier and say, I don't even know why Moody's would do something like this. Their entire rating scale is based upon the implicit assumption that the U.S. will always be AAA. If they were to downgrade it, they would have to downgrade every single dollar-denominated asset rated higher than the U.S. Isn't it terribly unlikely that the AAA rating is ever taken away from the U.S.?
You know, it probably is unlikely, especially as I mentioned, it's not a short-term issue. It's more, you know, a longer-term Social Security or Medicare issue that I think they're trying to raise as opposed to an immediate issue.
Let's talk about what gets upgraded. What do you like when you look around the globe as far as government debt or corporate debt in different countries, regions of the world that actually looks like it's on the right path?
You know, that's I think, the exciting part. When you go outside of the U.S. or outside of the G3, there's actually a lot of opportunities. There's a lot of governments over the last decade that have delevered massively, and especially in the emerging markets. You know, countries such as Indonesia that were in real crisis back 10 years ago now have very low debt levels. Over the next couple of years will probably even be investment grade rated. Many emerging markets have gone from junk to investment grade status, such as Brazil.
Right.
And then there are countries like Korea that are solidly in single-A ratings.
Hey, Michael, we've got to run, and unfortunately we've got to go to Intel earnings, but we'll get you back soon to talk more about this. Michael Hasenstab from Franklin Templeton Services.